Welcome to the deep dive. Today we're jumping straight into a really fascinating situation. We've got sources showing, well, fantastic financial growth for a major travel tech player, big strategic moves globally looking really strong. But then there's this shadow, highlighted by their own auditors, a serious regulatory issue that frankly could put a real dent in those profits.
It's quite the contrast, isn't it? And that's exactly what we're digging into today. We're looking at TBO Tek Ltd's Q2 results for fiscal 26. That's the quarter ending September 30th, 2025. Our mission really is to understand the story behind these numbers. What's driving the growth? What's the strategy? And crucially, what's this risk all about?
Right. And just looking at the headlines, you see resilience. GTV gross transaction value up 12% year on year. That's about 8,900 crores, solid recovery. But then revenue from operations that jumped 26% year on year, hitting 568 crore.
Yeah, that gap is key.
That's a huge difference. Revenue growing more than twice as fast as the value of bookings. Something has clearly shifted there. Okay, let's unpack that. 26% revenue growth versus 12% GTV growth. It feels like they're squeezing more juice out of every orange, so to speak. How are they managing that? What's the magic?
Well, it's not really magic. It boils down almost entirely to what they call a favorable mix shift. Basically, they're selling more of the stuff that makes them more money. Less low-margin flights, perhaps, and more high-margin hotels and extras.
Okay, so break down that mix for us. Where's the profit engine really humming now?
It's overwhelmingly hotels and ancillaries. That segment became, well, more important in their total GTV. It accounted for nearly 64% in Q2, up from about 59% last year. And here's the kicker. That segment. It generated 87% of their entire gross profit.
Wow.
Yeah.
87%. That's incredibly concentrated.
It really tells you where the company's bread is buttered, doesn't it?
Absolutely. Now, for listeners maybe newer to travel tech, we talk GTV, we talk revenue. The bridge is the take rate. Can you just quickly define that? Is it basically their commission?
Exactly. Think of it as their slice of the pie. It's the revenue they earn divided by the total GTV they process. It's a direct measure of their pricing power, really. And that blended take rate for the whole company climbed to 6.38% this quarter. That's up nicely from 5.68% a year ago.
So not only are they selling more of the profitable stuff, they're actually getting a bigger cut on that profitable stuff too.
Precisely. You see it really clearly in hotels and ancillaries. Their take rate there improved to 8.5%, up from 7.6% last year. Now, airlines did see a bit of pressure. The take rate softened slightly to 2.41%, but the sheer strength and volume in hotels just pulled everything else up.
And that flows right down to the bottom line, I assume.
It did. Adjusted EBITDA, before factoring in costs related to acquisitions, came in strong at 104 crore. That's a healthy 16% jump year over year. And maybe more importantly, it pushed their margin up to 18.3% for the quarter. That's a good step up from the 16.6% they managed in Q1.
Okay, so the margin story is strong. Is this just a temporary bounce back, or is there something more structural going on with their efficiency?
Well, the sustained margin improvement definitely hints at operational factors. And what's quite interesting is how they manage their costs. SG&A, that's selling general and admin expenses. The growth in those costs really moderated compared to earlier periods. It suggests they're getting a better handle on their fixed cost base.
But Q2 is often a strong travel quarter, right? Seasonality could flatter those numbers, higher revenue covering fixed costs better. They're calling it structural operating leverage. Are we sure it's structural or just a good quarter?
That's always the question, isn't it? But the evidence leans towards structural, I think. Look at the numbers. SG&A costs grew about 17.5% year over year in Q2. Compare that to Q1, where SG&A grew almost 29%. So revenue's up 26%, costs up almost 17.5%. That does look like leverage kicking in. The platform's getting more efficient.
Okay, that's a fair point.
And they also talked about this compounding flywheel idea in their shareholder letter. It relates to how quickly their key account managers, the sales force basically, become productive. They shared a pretty compelling stat. 63% of the new account managers they hired in calendar 2025 are already breaking even, contributing positively to gross profit each month by the end of September.
That's fast. So new hires are hitting the ground running.
Exactly. It suggests their training and support systems are working better, getting people productive quicker. That feels structural, not just seasonal.
Makes sense. And beyond costs, they're clearly adding customers, especially overseas.
Oh, definitely. Their monthly transacting buyers, MTBs, hit over 30,600. That's up 8% year over year overall. But the real story, like you said, is international. International MTBs jumped by almost 24% year over year. That's where the growth engine is firing.
And where is that international growth coming from specifically?
It looks pretty broad-based, actually. Europe is still their biggest market for hotels and ancillaries, over 2,000 crore in GTV, growing a solid 20%.
Okay, standard strength there.
But APAC, Asia-Pacific, was the fastest growing region, up 41% year over year, hitting 523 crore GTV. They mentioned expansion in places like Singapore and Hong Kong, and Australia, off a smaller base, grew nearly 90%.
Wow.
MEA, the Middle East and Africa, also had a strong quarter, up 27% in hotel and ancillary GTV. And importantly, even India, their home market, stabilized. It had been shrinking, but it returned to slight positive growth, about 0.3%. So arresting the decline there is also good news.
Okay, so growth across the board, better margins, better cost control. And then, on top of all that, they announced this massive strategic move, buying Classic Vacations. This feels like a really big deal for them.
It's potentially transformative, yes, a major shift. The agreement was announced during Q2, but the deal actually closed just after the quarter ended on October 1st, 2025. They bought 100% of Classic Vacations, LLC. For those who don't know, it's a well-regarded US-based luxury travel company operating in the B2B2C space, so business to business to consumer.
Right, and the price tag wasn't small, was it? What did that deal look like financially?
No, it was significant. The total potential payout is up to $125 million. The actual amount paid at closing was about $110 million. Funding came from a mix of things. They took on about $70 million in credit facilities, and there was also an intercompany loan from the parent company down to a subsidiary, around $36 million. And you'll see a line item in the Q2 results about 13 crore in one-time acquisition costs, basically fees for getting the deal done.
Okay, so a big investment. What's the strategic thinking here? Why Classic Vacations and why spend $125 million right now?
I think there are two main drivers. First, it pushes TBO squarely into the high-end luxury travel market. That segment tends to be more resilient, less affected by economic ups and downs than mass market travel.
Better quality revenue stream, potentially.
Exactly. And second, perhaps even more critical, it gives them a major footprint in the North American market. That's a huge, wealthy source market for travel. It diversifies their geographic exposure, gives them significant US dollar revenues, and reduces reliance on maybe more volatile emerging markets. It fits perfectly with that Q2 theme, focusing on higher margin business, now in a very stable, high-spending market.
So it's about diversification, margin, and getting into that lucrative U.S. luxury space. Makes strategic sense. Okay, so strong quarter, big strategic acquisition. But we have to talk about the elephant in the room, that emphasis of matter from the auditors. Note 4 in the results, this regulatory challenge.
Yes, we absolutely do. It's crucial context. This involves a show cause notice they received, both the holding company and the joint managing directors, personally related to alleged violations of FEMA, the Foreign Exchange Management Act. And this isn't some minor compliance issue. It goes right to how they handled international payments.
The description is a bit dense. It mentions Section 3C, FEMA. Something about letting foreign agents book tickets and take payments in Indian rupees from people who weren't actually the ones traveling. Can you simplify that? What exactly did they allegedly do wrong?
Let me try. Essentially, FEMA rules are very strict about how foreign currency moves in and out of India. The allegation seems to be that TBO allowed foreign travel agents, let's say, one in Dubai, to book travel for someone, maybe an Indian resident, but accept payment in Indian rupees from a third party, not the actual traveler or the foreign agent, directly in foreign currency. It sort of bypasses the normal foreign exchange controls. The regulator is saying those transactions should likely have been handled differently, probably involving foreign currency flowing through proper channels.
Okay, I think I get it. It's about the currency and who paid whom. So what's the potential damage here if they're found to have contravened the act?
Well, the notice identifies the total amount involved in these alleged contraventions as about INR 712 million. But here's the really worrying part. Section 13 of FEMA allows for a penalty of up to 3 times the amount involved.
3 times, so potentially over 2.1 billion rupees. That's enormous.
It's a very significant potential liability, yes.
What have they done about it so far? Have they tried to settle?
They did try. They applied for compounding with the Reserve Bank of India. That's often a way to settle these things, pay a penalty and move on without admitting guilt necessarily. But the RBI denied their compounding application twice. Once in April 2025 and again in September 2025.
Being denied twice. That doesn't sound good. It suggests the RBI isn't keen on a simple settlement.
It certainly indicates the regulator views this seriously. So the matter has now moved to formal adjudication proceedings. Those were actually scheduled for November 3rd, the date these results came out. Because the outcome is totally uncertain at this point, the company has stated correctly that they haven't made any provision or adjustment in these financial results for this potential liability.
Right. So we've got this picture of really impressive growth and a smart acquisition, but it's happening alongside this major, unresolved, and potentially very costly regulatory threat. Hashtag tag outro.
That's precisely the dynamic tension you need to keep in mind. On one hand, TBO is showing strong underlying growth, fantastic margin expansion led by that hotels and ancillary segment, and they've pulled off a major strategic coup with the Classic Vacations deal, strengthening their position in the lucrative U.S. luxury market. But on the other hand, they're facing the significant FEMA investigation, where the potential penalties are, frankly, quite large relative to their current earnings.
So for you listening, the takeaway is a company firing on almost all cylinders, capitalizing on the travel rebound, making smart strategic moves, showing real operating leverage. The core business looks healthy and increasingly efficient. But here's the final thought to leave you with, something to really chew on. We talked about that successful cost control, that emerging structural operating leverage. The business model seems increasingly scalable and profitable. The big question is that newfound efficiency and margin strength robust enough? Could it actually absorb the shock of a potential maximum penalty under FEMA, that 3 times the contravention amount? Or would a hit like that derail the impressive growth trajectory we're seeing? How that plays out will really shape TBO Tech's next chapter.